If the stock market drops 10% tomorrow, what would you do? Would you panic, sell everything, or freeze and hope it goes back up? Because here's the truth. A 10% drop is not rare. It's normal. It happens almost every year at some point. But most people still react emotionally, and that's where they lose money. Today, I'm going to share my exact plan if markets crash 10%. No drama, no hype, just strategy. First, I do nothing emotionally. That's step one. When markets fall, your brain goes into survival mode. You see red numbers, headlines screaming crisis, and suddenly it feels like the world is ending. But a 10% correction is not a crash. It's a reset. Historically, markets have always recovered from corrections. So rule number one, I don't sell quality investments just because prices fall. Now step two, I check my emergency fund. Before I invest a single dollar, I make sure I have 3 to 6 months of expenses in cash. Why? Because if I lose my job or income slows down during market stress, I don't want to be forced to sell investments at a loss. Cash gives you power. It gives you patience. If your emergency fund is solid, market drops become opportunities instead of threats. Step three, I rebalance. When markets drop 10%, certain sectors fall more than others. Tech might fall 15%. Energy might fall 5%. Bonds might even go up. So I look at my portfolio allocation. If my target is 70% stocks and 30% safer assets, and now stocks are 65% because of the drop, I rebalance. That means I slowly buy back into stocks to return to my target allocation. This forces me to buy low, automatically. No guessing, no predicting, just discipline. Step four, I invest consistently. If I'm investing monthly through dollar cost averaging, I don't stop. In fact, I get excited. Because when prices fall 10%, I'm buying the same companies at a discount. Imagine your favorite store offering everything 10% off. You wouldn't run away, you'd buy more. The stock market works the same way.
Step 5. I focus on quality. In uncertain times, weak companies struggle. Strong companies survive. So I focus on businesses with strong cash flow, low debt, and consistent earnings. I'm not chasing hype stocks. I'm not gambling on rumors. I'm investing in businesses that will likely still be here 5, 10, 20 years from now. Step 6. I zoom out. Open a long-term chart of the S&P 500. Every drop, 2008, 2020, 2022, looks terrifying in the moment. But zoom out 10 or 20 years, and those drops look small. Time in the market beats timing the market. If you're investing for retirement or long-term wealth, a 10% drop is noise, not a disaster. Now, here's what I don't do. I don't watch the market every hour. I don't react to breaking news. I don't try to predict the bottom. Because nobody consistently predicts bottoms. Not experts, not banks, not YouTubers. The goal isn't to be perfect. The goal is to be consistent. And here's something important. Corrections create future gains. Historically, after 10% corrections, markets often recover within months. The investors who stay calm benefit the most. So if markets crash 10%, my exact plan is simple. Stay calm, keep cash ready, rebalance, keep investing, focus on quality, think long term. That's it. No panic, no dramatic moves, no emotional decisions. Because building wealth isn't about reacting to every drop, it's about surviving them. If this helped you think more clearly about market drops, subscribe. We're building financial confidence here, step by step. And remember, smart investors don't fear corrections, they prepare for them.